Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Thank you for listening to Stocktake, the podcast from Intelligent Investor. For a free trial, visit intelligentinvestor.com.au. Good morning, everybody. My name is John Addis. I'm the founder of Intelligent Investor, and today we are talking about spinning flywheels. There are a few things in investing conceptually that I think are worth concentrating on, and the flywheel is one of them. And to talk about the spinning of flywheels, I have here with me this morning Gaurav Sodhi and Nick Cummings. How you doing?
Thanks, John. May I say we're both quite familiar with spin, so this should be an easy task.
Ditto.
Well, let's kick things off by defining what a flywheel is and why it's important. Let's start with you, Nick.
Yeah, so I guess the flywheel, the concept, I think originally, and you guys might be able to correct me, comes from the book Good to Great by Jim Collins.
Can I just interrupt already? That if you're going to read one business book, and I would say that most people should not waste their lives reading business books, Good to Great is a really good place to start. It's an excellent book, and it's a key concept. Please continue, Nick.
Yeah. Anyway, he sort
John
of
receives a $1 royalty for every book sale of the book.
Wish I wrote it.
Absolutely. He makes the point that at the start of any business that they make these small changes, little features that don't really add up to anything or don't really start to move the flywheel. The flywheel at the start's really, really hard to push. It's really heavy. But over time, all those all those incremental product changes and upgrades and features actually start to build the customer experience, build the product or service that the company's offering, and then that momentum builds on itself and becomes self-sustaining. I actually prefer to think about it actually like a boulder at the top of a mountain that's really hard to push off. And
you can't put another metaphor on top of a metaphor, Nick.
No, I know, but I actually just find it easier to think. Yeah, I actually just find it easier to think about. But once you sort of get it off the hill, it rolls slowly and then really builds speed as it falls down the hill. That's how I sort of think about it. Obviously, I think we'll talk about it later. But Amazon's the classic flywheel example.
Yeah, before we get into that, because I think there is, like, when Jim Collins described this, he I don't know whether he was thinking of the kind of thing that Amazon does. More it was about, like, you get this thing going, you have a big idea when you start a business, and the push is really, really difficult to get that flywheel moving. But if you can walk into the office in the morning and think, I'm going to improve this business by 1% a day, what you end up doing is creating a sense of momentum in that business that really has a compounding effect. So by making small changes, maybe to the customer experience, to your supply chain, to distribution, to your advertising, you can actually build up something with some momentum. How does that differ from your conception of how people think about flywheels now, Gaurav?
I think about it differently to that. That's the original Collins explanation. Yeah. And I think that's morphed a little bit into something like a positive feedback loop. And I think we all know what that is. That's when one change compounds another change, which then strengthens the original change, which then leads on and on and on. So a classic example would be something like a JB Hi-Fi, right? Where the stores, the business gets a particular scale, which allows cheaper purchasing, which allows for lower prices, which allows for more customers, and more customers reinforce more scale, which reinforces lower purchasing costs, which reinforce more customers. So at every point on that flywheel, one action reinforces another, and once it's all underway. So at any single point of that flywheel is difficult to replicate by itself, but when they're all kind of working in sync, the impact is really powerful, and it's quite difficult to stop and to disrupt. And that's the way I kind of think of it. I think it is a little bit different to
I think so.
To Colin's original conception.
I think the theory has kind of evolved a little bit, and I think that the internet has enabled that involvement in some way. And if you look at the ASX listed businesses with classic flywheels, you're probably looking at the classified businesses where, say, with the REA Group, the more houses you get listed on the site, the more traffic you generate, the more agents you attract, the more advertisers you get, the more listings you get, the more users you get. So you can see that inbuilt dynamic there that spins, and that applies to Seek, it applies to car sales. You can also see it in companies like Xero, where the more small businesses you get on the system, the more accountants come on, the more integrations you build through their app store, the stickier the platform becomes, the lower the churn, the higher the profitability. And I think this is really what has changed. The internet has really changed how people think about flywheels, which probably brings us to Amazon, Nick. I'm going to start off with a question. Who or what was Jeff Bezos's original venture capital firm that he started with, where he pitched the idea of an online retail store and they rejected it? Can you remember the name?
Stupid.com, was it?
I'm not sure. I mean, I know he worked for D.E. Shaw,
That's it.
famous.
That's
one of the most famous, or has gone on to be one of the most famous hedge funds in history.
Wow, really?
Yeah. And he pitched the idea to them and they rejected it. And he thought he came up with loads of different ideas for selling stuff online. He just thought books were the best because they had a really, really long shelf life. They were easy to send in the post, big product range. It was the ideal kind of thing.
Yeah.
But
that was the key feature, John. Just that he estimated there was 3 million books at the time.
Yeah.
And that no one bookshop could hold all that inventory. So the limitless, shelf space of e-commerce made books just perfect.
Yeah. Yeah. So let's explain the Amazon flywheel, because I think in some ways this is the most developed conception of it. We'll talk about Amazon first, and then we're going to talk about an ASX listed stock that really has its own flywheel, probably not as significant as Amazon's, but equally interesting. Let's just take a quick break, and we'll be back in a few moments to talk about Amazon's flywheel.
What if your next investment could beat the ASX 200? The Intelligent Investor Australian Equity Growth Fund is built to do just that, and it's backed by a team with a 25-year research track record. This actively managed ETF gives you access to a no-holds-barred portfolio of the team's best ideas. And from the new financial year, the fund will expand its mandate to include up to 30% in global shares, allowing the team to invest in global businesses they believe offer better value than their Australian counterparts. For a limited time, you can invest in the fund with zero brokerage fees directly with Intelligent Investor. Learn more at offer.intelligentinvestor.com.au/IIGF.
And we're back to talk about Amazon. Nick, tell us about the Amazon flywheel.
Yeah, so whenever I hear the word flywheel, I immediately think of Amazon. And why that's the case is other companies have been quite successful creating their own flywheels. We've mentioned a few already, but there's no model like Amazon's where the flywheel, each flywheel is interconnected to another and actually powers another in the same way. It's really incredible.
What do you mean by that?
So let's just start with their e-commerce flywheel, and that is essentially similar to what Gaurav was saying with JB Hi-Fi, that lower prices attract more customers.
Yeah.
More customers attract more third-party sellers. That's their marketplace business, which is another flywheel.
Yeah.
The more sellers you have, the better selection you have. The
Yeah.
better selection you have, the more customers you have, the more and ultimately the more sales you get. The more sales you get, the more that can be spread over a fixed cost base that lowers costs, and then those cost savings can be passed on to customers in the form of lower prices.
Yeah. Now, before you expand on that, Nick, let's just make a comment about that flywheel in itself. Is that once you achieve it, it becomes a competitive advantage that tends to deliver higher growth and higher margin growth. Would you agree with that?
Yeah. And once you achieve that, what Amazon's shown is once you have that first flywheel, which was their first party retail business, where they're just a retailer, they take control of the inventory, like, a JB Hi-Fi. Once you establish that and build that traffic funnel, it can be then used to spawn other flywheels. And that's what they've done with sort of the third-party selling business. That's what they've done with advertising, Prime membership, and distribution and fulfillment.
Let's break that down a bit then and talk about, say, with sellers. How has that become a business in and of itself through providing this kind of functionality to sellers to get on the original retail platform?
Yeah, so the third-party selling platform is just a marketplace business, and those sellers were originally attracted because the first-party retail business had brought this massive traffic funnel. So that encouraged more sellers to get on board. The more sellers that got on board, the more they competed with each other to lower prices. And then what ended up happening was they had different customer experiences. So if you went to Amazon and you were buying an Amazon first party good, you were getting one delivery speed because Amazon was delivering the product. But then if you bought a product from a third party seller, you were having a different customer experience because the product might arrive 3 weeks, whereas another good might arrive in 5 days. So that was a bit of a problem for Amazon. So they solved that, or attempted to solve that, by introducing distribution and fulfillment. Mm-hmm. And this was when they offered third-party sellers and said to them, hey, we can do all your deliveries, returns, and you can stock your goods in our warehouse. And so what that did was it, one, improved delivery speeds, and now they've got it down to same day and within an hour or 2 hours in some US cities, which is just incredible. And by improving delivery speeds, you improve sales as well. If goods arrive quicker, consumers transact more. So that powers the other flywheels. And also by bringing in third-party inventory into their warehouse, it causes warehouse capacity to go up. So that lowers costs. So and you can also deliver the goods in. You can pack the trucks with more inventory, and you have higher density areas. So that also lowers costs.
Okay, and good. And Amazon has managed to do this in different parts of its business to the extent now it's kind of built businesses you wouldn't have imagined when that first flywheel was established.
Yeah, 100%. I mean, Amazon Web Services is now its probably most valuable segment, or definitely its most valuable segment. It has $100 billion in sales. And it was originally created because they were running into trouble in the retail business because their software engineers and developers were spending all this time solving infrastructure computing issues, so issues with their servers, their storage and databases, rather than actually building new products and features. So they actually decided to create Amazon Web Services, and they could do this and spend the money to do this because they knew Amazon was always going to be the largest user of this product. So it didn't really matter if they could resell it to others, which they obviously have, because Amazon was always going to be the largest user. So it was always going to cut a cost out of their business, and it was going to improve logistics, customer experience in the retail business. So that's an example of how it's not obvious how the AWS and the e-commerce business are flywheels that are interconnected, but they are slightly connected. Yeah. And a new one that you and I have talked about, John, Kuiper, their satellite broadband offering.
Mm-hmm. This is a Starlink competitor.
Yeah, the Starlink competitor. This product actually hasn't been released yet, but they've just launched the first satellites into orbit, and they plan to have, I think, 3,200 in orbit by 2029, which should cover most of the world. Now, if we start to think about how this flywheel will develop and, sort of think about it in the way that Amazon has conceptualized their flywheel model, it's Amazon will likely be the largest user of this product. They have assets all over the world. They will almost definitely be the first and largest user of this product. Secondly, a Flywheel like Amazon's Prime membership could be used to bundle a satellite broadband offering. So Kuiper initial sales could be powered by the Prime membership base. And then non-Prime members may sign up to Prime because they want to get access to Kuiper and all the other perks. Then the more Prime members that sign up, that powers. We know they transact more often in the retail business or the e-commerce business than non-Prime members. So all of a sudden, you've got this satellite broadband offering that doesn't have anything really to do with e-commerce that could potentially power sales in e-commerce. And then likewise with AWS, they're going to offer AWS customers private connectivity from all over the world. So this is like a very attractive offering for governments and for enterprises with sensitive data. So again, not obvious, but Kuiper could power the AWS Flywheel as well.
Yeah, it's incredible to think you can build these massive businesses just through developing these internal structures to build the business you've already got. And I think Amazon has a word for this. I don't know if you know what it is, Gaurav. I think it's modularization, where you might build expertise in developing cloud businesses because you want to service your seller network, but that expertise can then be commodified and sold elsewhere in the same way that Nick has just described. The satellites will help Amazon develop a better business. Maybe they'll allow drone deliveries and stuff like that. They're the biggest customer, but then you open that network up and you sell it to other people, and it becomes a much, much bigger and independent business, even though its genesis was inside the existing flywheels.
It reminds me a little bit of MinRes, actually, just listening to Nick speak about it. I never made that connection before, but
wow, that's a bit cool.
that's quite a leap.
We might have to take that out, Greg.
It's too wild.
As a message to the producer. This might come to haunt Gaurav. Leave it in.
Let me I'll just explain this. So Onslow, MinRes's large iron ore development asset, which is sort of a $4 billion project. They spent more on Onslow than their entire market cap at the moment. So it's a huge gamble. And that area had been sort of looked at for about a decade or more, but no one else had been able to develop it. And the difference was that MinRes had all this large services business, particularly this crushing business, which they could internalize, right? So they knew, just like Amazon knew that AWS would largely service Amazon as a customer, MinRes knew that Onslow would generate revenue for the services and crushing business as a customer. So there was an internalization of revenue there. So the project was really able to get off the ground because it provided so much work for another division. And it sounds like the same deal happened at Amazon, Nick, that AWS was only able to get built because of sort of the guaranteed work that they would have from the retail arm of Amazon.
Yeah, 100%. That's typically with Amazon, not in every case, but almost in every case, that each new flywheel, Amazon is the first and at least they plan it to be the largest user. And that's likely to be the case going forward as well.
I think when AWS was first created, actually, I remember reading in an article that IBM and AWS went head-to-head for a CIA contract, and IBM were kind of laughing at Amazon, thinking, how are these booksellers going to win the contract from the most difficult agency in the US government to win work from? And it absolutely shocked the pants off them when the CIA chose AWS. That was their first major customer. And that's when the clear lead that AWS had became clear to everyone. And no one really recognized it because a lot of the growth and development of AWS happened internally because of all the Amazon revenue it was feeding. It's actually such a great comparative advantage, having that large retail business to try different ideas and spin them off.
Yeah, and I think it's also a bit about moat protection for Amazon. So I mean, you can see it now with these large enterprises that are relying on Amazon, and sort of, if Amazon wants to raise the prices, which they haven't been doing in AWS, but if they wanted to, what is the business going to do? And it was the same for Amazon previously. I think they were on Oracle, and it took them, I think, 15 years to fully get off Oracle and into AWS. Yeah, it took a long, long time to get every workload off. But it takes out a risk that you are not beholden to Oracle anymore. And they've done that with delivery as well. They were really beholden to FedEx and UPS, whereas now they actually deliver, I think, the majority of their parcels themselves. So they fulfill the majority of orders with, their delivery trucks. They own a fleet of aeroplanes. They've got warehouses everywhere. But again, that reduces the business risk as well, because they're not relying on UPS or FedEx that can push up the prices as much.
Let's now talk about an Australian business with a flywheel effect. Gaurav, we've been, I wouldn't say we've been long-term holders of AP Eagers Automotive, but we only bought it, I think,
a year ago.
About a year ago.
Yeah,
it's Australia's biggest retailer of cars, I believe. It sounds like a very boring and dull business. How on earth does this have a flywheel?
Yeah, I must say, I was sitting at the AGM and listening to management speak. I was still learning about the business at that stage. I remember within sort of 10 minutes of listening to these guys, I knew that I was going to buy that stock, and I bought stock before that meeting even ended.
When was that?
This was in about a year ago, May last year.
Right.
And they actually, in that meeting, they had announced a huge downgrade, and the stock fell 20% that day. And you could just see that this was a great business. One of the things that gave it away for me was that just most of the people around that room were former employees and ex-managers, and they'd come to the AGM, and they're all shareholders. And people who leave a business and continue their shareholding in it and engage at the AGM, that's a great tell. That's a huge tell of a fantastic business. And what we didn't realize at the time, though, was that not only was Eagers a dominant new car business, and the new car business, as we've made the case for in the review when we wrote that up, was a better business than it appears, because it comes not only with a retail margin attached, but it comes with finance fees and insurance income as well. So there's other fees that get derived from every new car sale. There's more fees attached to it. But what the new cars also come attached with is a trade-in. And when you have the 12% of the market, so 5 times your competitor, you get so many more trade-ins than anyone else. And trade-ins are the cheapest way to source cars. You won't source them any cheaper than that. And Eagers is sitting there with a dominant new car position, having access to all these low-cost trade-ins, right? Now, traditionally, car dealers will allocate those trade-ins to the dealership that they were originated from. So if you're in, if you're in Sydney as a Sydney car dealer, and you sell a car and you get a trade-in, that trade-in belongs to you. But what Eagers did is they centralized all their trade-ins together and created a second-hand car business called Easy Auto 123. And it was all automated, it's all online, and all fixed prices. And they all operate from a handful of giant warehouses around the country. And they sell a lot of their cars just over the internet. And the competitive advantage there is that all the trade-ins get centralized, sold through Easy Auto 123, the used car business, and then the originating dealership collects a fee for selling that car, for originating that car. So for the originating dealer, it's another fee attached onto a new car sale.
Right.
But it also creates this really large used car business, which is counter-cyclical, really high turnover, and surprisingly high margin, as we discovered when we went and visited that business. And that was completely hidden from us originally. Yeah. We had no idea we thought we were buying an okay new car business. What we didn't realize was that there was this fantastic hidden used car business along with it.
Yeah.
And the flywheel there, John, is that because they're so dominant in new cars, they can source a volume that no one else can source at a price that no one else can source, and they can sell them then at cheaper prices than almost anyone else. So the new car business provides cost advantage to the used car business, which then turns over inventory really, really quickly because of the cost competitiveness, and that attracts more customers. And so there's always a market for collecting and selling those trade-ins that originate from the new car business. So it's not as elegant and powerful a flywheel as Amazon has, but in its own way, it is a reinforcing mechanism because one part of the business feeds off another, and they both work in an interconnected way to generate superior returns. You couldn't set one up without the other, and they both are in a sort of an interdependent relationship.
Yeah, I think one of the ways to think about this is instead of thinking about different parts of the business and how they interact with each other, it's good to take the customer's perspective and thinking about it from that. So if you're buying a new car, as I have just done through...
Oh, did you? I didn't know that. Yeah. Did you get the shark?
No, I didn't get a shark. I ended up getting a dolphin.
If someone just walked in on that conversation, they would sound really weird.
No, I've never bought a new car. I just see them as terrible investments.
Same here. I don't buy new cars either.
But I bought a new car for the first time in my life. And if you think about that purchase, so BYD is Eagers has the exclusive distribution in Australia with BYD. BYD sales are just going through the roof at the moment. And I think it's an excellent, well-priced product. But Eagers they'll get the sale. Mm-hmm. Maybe they'll get some of the insurance. They will get the servicing.
Did you finance the car?
They'll get the finance.
Yeah. That's a huge fee.
That's probably worth more than the car itself, I'd say.
Often it's a higher it's a higher charge than the retail.
And then
margin.
So you get the servicing all the way through. And when we went to the Eagers outlet in Indooroopilly in Brisbane, you could see how nicely integrated the sales showroom was with the servicing component and the shopping centre there. It was a really, really clever layout. But then at the end of that lease or at the end of the purchase, I think I'm going to trade it in. I might take it to Easy Auto 123 and get a trade in there and then maybe buy a secondhand car or go back to the showroom and buy another one. And one of the things about any kind of sales process is the cost of customer acquisition. It's one of the key metrics in any business. And the more revenue that you can generate from one customer, the bigger the flywheel you've got. And you can see in that, say, that 3 to 5 year association that I might have with Eagers, there will be any number of points along that period where they will be extracting revenue from me. Having acquired me as a customer, they don't just get a one-off revenue hit of the sale of a car. They might get 6 or 7 different interactions, maybe more if I service it there every year and buy new tires and stuff like that, where I become the value of me as a customer, the lifetime value of me as a customer is so much greater than just the sale of one car. And that is a flywheel. I do believe that's a flywheel.
That's interesting. I must admit, I did not think of it that way, but that makes sense, eh?
Yeah, I think it's a useful way to conceive of it. Nick, what did you think of Eagers when we went there in September last year, and we saw that giant shed with 400 vehicles in it?
Yeah. I mean, to be honest, when Gaurav first brought the idea up and then we was saying, this is a much higher quality business than anyone thinks it is. I was pretty skeptical. I just thought this was just a scaled sort of car retailer. But once we went to the auto mall and we saw the servicing and we saw the sales tactics as well, it was very, very cruisy. They weren't in your face.
Very comfortable.
It was very comfortable. And then we went to the used car business as well the next day, and it's this massive warehouse where there would have been hundreds and hundreds of vehicles, and also outside Brisbane a little bit, like North Brisbane. So that, as Gaurav was speaking about, that by taking the vehicles from the new dealerships, which are in usually higher valued real estate areas or more frequent real estate areas, and moving them to warehouse, they can really cut costs and doing it all online as well. Really cuts costs, and they can, not only be the most scaled operation, but by far the lowest cost as well. And I didn't really piece that together until, we walked around that showroom, I guess. Well, if you call it a showroom, I mean, it had industrial sized fans and John missed the turn and all the rest of it. But it's I've definitely gained a lot more respect for these businesses, for sure. And you can see it in the financials. Like AP Eagers turns over their inventory about 7 to 8 times a year, whereas other car retailers on the ASX is below 6 times a year. And so that means the vehicles are on the lot for a shorter period of time. So it means interest costs for those cars are shorter. It means the fixed costs of that real estate can be spread out over more vehicle sales. And that leads to profit before tax margins that I think are about 3.5%.
3x the competition, that's right.
Yeah, 3 times greater than the competition. And mind you, that competition is the ASX listed peers. We're not talking about mum and dad operations or like they're scaled operators in their own right, but just nowhere near Eagers. So the advantage over a smaller dealership might be even greater. It's really incredible, and I was just surprised about how good this business was.
Yeah,
that metric you brought up, Nick, that inventory turn is absolutely crucial. It's crucial in any retailer, but for this kind of retailer in particular, because they don't actually purchase the cost of the vehicle; they pay monthly finance on the vehicle. So the longer the car sits on the lot, the higher the cost of goods is. So you actually maximize your gross margins by turning over inventory faster. So it's a unique point of car retailing.
Yeah, and I think one of the things that I would say to listeners is the benefits of going out and talking to staff who work in these kind of places is a lovely thing about a retail business. Yes. We discovered that they were incentivized they made less money the longer the car sat on the lot.
Yeah.
Yeah.
So they're heavily incentivized to turn over inventory, but they can't just do it through lowering prices. There are steps that have to be taken. Like if a car isn't sold within a certain period of time, then you can reduce it by $500. But you can't just slash the price to move the inventory. So you can find out these things by visiting these places and talking to these staff. They weren't especially open, but we did manage to.
Oh, John, your manipulative tactics. Nick and I all learned something that day.
Yeah.
So
it's like the Jedi mind trick.
Let's move along and quickly talk about the price guide now for Eagers before people know my secrets. Look, we bought this stock at about $10.50, I think, middle of last year, Gaurav.
That's right.
Everybody's realised how good a business Eagers is now. The PER's kind of doubled. The share price is up, 80% in less than a year. Where are we now?
Yeah, it's been quite extraordinary. I must admit, I thought this was going to be a lower
3-year thing.
Yes, that's right. I thought it was going to be a 3-year thing, and we've gotten to $20 pretty quickly, and we've done that while margins in the business have actually fallen. I mean, they were coming off these crazy highs, and everyone knew margins would fall and that they would normalize. I think that was the opportunity. I think the market kind of freaks out when they expect margins to fall and they can see something bad in the future, but they don't exactly know. There's a certain uncertainty around it, and that uncertainty means no one wants to touch the stock. And so $10 was always a stupid price for this business. That's what really got us involved in the company was the very low valuation. Yeah. But we're now at a point where the earnings are probably going to be lower this year than last year, and yet the multiple has doubled. Look, I still think a long-term approach for this business makes sense because there are durable, genuine competitive advantages here that cannot be disrupted. Really difficult for anyone to take on Eagers. So a long-term holder will do very well from here, but I do think a lot of returns have been front-ended, and it makes sense if your position size has grown a lot. It makes sense to just trim it a little bit. And I'm going back to the AGM this year, and I think we'll come up with a revised price guide after that. We'll spend some time there and chat with everyone there and get a better feel of how the business is going.
Mm-hmm.
But I do think this is a business one can hold for a long period of time. It's really just tweaking that portfolio allocation. And in times where the multiple expands like this, you probably don't want to be holding your maximum allocation, and you want to be adding to it when the multiple contracts. And you'll get those because it's still a cyclical business. For all its quality and for all its dominance, this is still a heavily cyclical business. So you will get movements in sales, and that would lead to movements in the share price.
Right. Now, what about Nick and Amazon? Where do you feel as though we're at with the stock price and the value that's on offer there?
Yeah, so we wrote an article a couple of weeks ago where we actually upgraded our buy price to, I think, around 170. And we just made the point that Amazon is right now they've got these two massive opportunities in e-commerce, where only 20% of the world's, or even less, of the world's sales are actually online, and they're the global leader. Wow. So if that goes to 50%, Amazon's going to benefit enormously. The same with AWS. 80% of IT workloads are still on premise, and so that means they've only got 20% of the market so far, split between Azure and Google Cloud as well. So these are two huge opportunities. So it really just depends what you want to pay for this business. I think over time, the growth rates of the past, they probably won't be able to repeat, but you can still get 20% earnings per share growth, I think, over the next sort of 4 to 5 years. So it's really on what members and other investors want to pay for this business.
That is extraordinary, Nick. I find it difficult to wrap my head around that. A business that size growing 20% EPS. What's the multiple now, by the way?
So when it fell,
it's been in ages.
It isn't anymore. It's bounced back a lot. So it did fall. It fell from about $240 to $160 when the tariff news came out in April, and at that point it was at its lowest operating cash flow multiple ever.
Whoa! Okay.
Yeah, which is partly because growth rates going forward will be lower, but also that was the uncertainty of of the month as well, and those tariff announcements. So yeah. It's bounced back a bit. I think it's probably fair to undervalued at the moment. We added some in the Intelligent Investor Select Value Fund during April, and made it one of our larger positions, just because you've got those two big opportunities, but the moats around these businesses are just massive. AI could be an opportunity, but it's certainly not a threat. As it is to some of these other large tech businesses like Google. I think it's just really, really, really well set up. So, I mean, we hold it. I definitely wouldn't be selling it at current prices, even though they've risen.
A special call out to Nick as well, who put this in the Select Value Fund in May 23 at a price of $113 US. That's up probably 65-70% since then. And still not that far away from the buy price. And I think that just emphasizes the point about how this business can, it's mad that a company this size can grow at that rate and keep on spinning off new businesses. It's just testament to the power of a really, really good flywheel and a management team that really knows how to do it exceptionally well. So this is a great call, Nick. I think we're going to end it there, though. We're already at about 35 minutes, so it is time to say goodbye. Thank you, Nick, and thank you, Gaurav. We'll be back with you in 2 weeks.